The US-China trade war goes beyond merely correcting trade imbalances. It is rooted in deeper conflicts over technological supremacy and national security. The United States has expressed strong concerns regarding China's intellectual property infringement, forced technology transfers, and industrial policies such as Made in China 2025, demanding corrective actions. On the other hand, China remains committed to its economic growth strategy and has shown a stance of avoiding concessions in response to external pressure. Due to this structural conflict, experts believe that a short-term resolution of the US-China trade war is unlikely. While it is difficult to predict a precise timeframe, some analysts suggest that it could last for several years, or possibly even more than a decade. For example, a report by Mitsubishi UFJ Research and Consulting highlights the rapid convergence of the US and Chinese economies, which is considered a key factor escalating tensions between the two nations. Hello. In this video, we will discuss whether the US-China trade war is expected to last for more than 5 years from 2025 to 2030, and whether technology-related stocks will experience a significant decline. If you find this video interesting, please like and subscribe to the channel. Stock market trends in Japan and the United States in the event of a prolonged conflict. The prolonged US-China trade war will have a significant impact not only on both countries but also on the global economy as a whole. In particular, the stock markets in Japan and the United States are expected to be affected by the following factors. Impact on the Japanese stock market. Impact on export industries, supply chain disruptions and countermeasures. Japan's automotive and electronics industries heavily rely on the Chinese market and components supplied via China. For example, automakers such as Toyota and Honda source parts from China for export to the United States and Europe. If the US-China tariff hikes continue, manufacturing costs for products passing through China will rise, ultimately squeezing the profit margins of Japanese companies. In particular, any disruption in China's supply of EV electric vehicle technologies and batteries would have a severe impact on Japanese EV manufacturers. On the other hand, companies are taking steps to hedge risks. For instance, Sony and Panasonic have begun relocating parts of their production from China to Southeast Asia to mitigate tariff risks. However, such relocations take several years to complete, making short-term cost increases inevitable. Deterioration of investor sentiment and its impact. Insights from past data. During past trade conflicts such as the US-China tariff war of 2018-2019, Japanese export-related stocks, particularly those in the Nikkei 225 with high export ratios, experienced significant declines. For example, in December 2018, the Nikkei stock average fell below 20,000 yen, with electronic and semiconductor-related stocks seeing particularly sharp drops. Investors tend to shift funds into safe haven assets, such as the Japanese yen and government bonds, when prolonged trade disputes threaten the performance of global corporations. If US-China tensions continue beyond 2025, similar trends are expected, which could have a significant impact on the performance of Japanese stocks. As a result, investors will need to carefully assess the risks associated with stocks that are highly dependent on external demand. The impact of the US-China trade war may increase cost pressures on Japanese export companies and deteriorate investor sentiment, raising the risk of stock price declines. In particular, as supply chain restructuring progresses, it is crucial to monitor not only short-term market fluctuations but also mid to long-term changes in corporate strategies. Impact on the US stock market. Pressure on corporate earnings. Impact on the technology and agricultural sectors. A prolonged US-China trade war could significantly impact the performance of technology and agriculture-related companies. Impact on technology companies. US semiconductor and telecommunications equipment manufacturers, such as Apple, Qualcomm, and Intel, have a high revenue dependency on the Chinese market. Trade tensions and supply chain disruptions could lead to a decline in their financial performance. For instance, Apple relies on China's Foxconn for iPhone manufacturing, and sales in China account for approximately 18% of its total revenue. If tariffs are imposed, production costs will rise, leading to higher retail prices in the US, which could weaken consumer purchasing power. Furthermore, China has a history of retaliatory measures, such as its past efforts to eliminate US products following the Huawei dispute. If trade tensions escalate, new regulatory restrictions could be imposed on US companies. For example, Microsoft's cloud services and Tesla's sales in the Chinese market could face heightened risks. Impact on agriculture-related companies. China is the largest importer of US soybeans and corn. During past trade disputes, such as China's tariff hike on soybeans in 2018, US agricultural companies suffered significant losses. If trade friction intensifies again, companies like John Deere Agricultural Machinery and Cargill Food Processing may experience declining demand and deteriorating earnings. Rising inflationary pressure. Impact on consumers and monetary policy. The intensification of the US-China trade war could lead to higher tariffs, driving up the prices of imported goods and causing consumer price inflation. If the prices of Chinese-made daily necessities, home appliances, and apparel on which U.S. consumers heavily rely soar, consumer purchasing power may decline, dealing a blow to the retail and distribution industries as a whole. If inflation persists for an extended period, the Federal Reserve (FRB) may accelerate monetary tightening interest rate hikes. A similar situation occurred during the inflationary phase of 2022, when the FRB's aggressive rate hikes led to a significant decline in stock prices. There is a high risk that a similar scenario could unfold again. The U.S. stock market will face dual pressures from the deteriorating performance of technology and agriculture-related companies, as well as the risks of inflation and monetary tightening, due to the prolonged U.S.-China trade war. Investors will need to adopt asset management strategies that take these structural risks into account. The rise of Southeast Asia. Shift to Southeast Asian manufacturing and economic growth. As the U.S.-China trade war prolongs, many companies are seeking to reduce their reliance on China and establish new production bases. The most promising alternative is Southeast Asia ASEAN countries, with Vietnam, Indonesia, Thailand, and Malaysia already strengthening their roles as export hubs for the U.S. and Europe. Vietnam rapid growth in the electronics industry, driven by Apple's supply chain relocation and Samsung's manufacturing expansion. Indonesia increasing investment in EV electric vehicle battery production. Thailand and Malaysia emerging as key hubs for automobile and semiconductor manufacturing. Amid shifting global trade dynamics, these countries are strengthening free trade agreements (FTAs) with the US and the EU to expand their export markets. Challenges in Southeast Asia: infrastructure and workforce shortages. While Southeast Asia is experiencing rapid growth, several challenges remain before it can match China's manufacturing capabilities. Underdeveloped infrastructure. China boasts world-class industrial parks and logistics networks. In contrast, many Southeast Asian countries still lack fully developed ports, highways, and power supplies, making large-scale manufacturing relocation a time-consuming process. Skill gap in the workforce. China has a vast pool of highly skilled technicians, whereas Southeast Asia faces difficulties in securing skilled workers and managerial talent. This issue is particularly severe in high-tech industries such as semiconductors. Political risks. Countries like Indonesia and Thailand continue to experience political instability, posing potential risks for investors. Japanese companies' strategies and investment opportunities. As a result of the US-China trade war, Japanese companies are also accelerating their investments in Southeast Asia. Sony and Panasonic promoting the relocation of manufacturing bases to Thailand and Vietnam as alternatives to China. Toyota and Honda expanding EV-related production in Indonesia and Thailand. Japanese semiconductor manufacturers strengthening manufacturing capabilities in Malaysia and Singapore. Going forward, investors may find new opportunities by focusing on the growth of Southeast Asian companies and related ETFs. Southeast Asia is emerging as the new manufacturing hub amid US-China tensions. However, challenges in infrastructure and workforce development remain, and it will take time for the region to fully function as a replacement for China. Companies and investors must carefully assess short-term risks and long-term growth potential. Supply chain restructuring and the rise of Southeast Asia. As the US-China trade war prolongs, many companies are strengthening their China Plus One strategy and shifting production to Southeast Asia. However, fully replacing China's manufacturing capabilities remains challenging, highlighting the following issues. Underdeveloped infrastructure and logistics constraints. Many Southeast Asian countries lack well-developed port, road, and power infrastructure, making it difficult to support mass production and large-scale transportation. For example, logistics costs in Vietnam are estimated to be about 20% higher than in China, and limitations in transportation capacity have been pointed out. In particular, congestion at Ho Chi Minh Port is a serious issue, increasing the risk of shipment delays. Labor quality and cost issues. While China has a large pool of highly skilled workers, Southeast Asian countries still face a shortage of experienced labor. In Vietnam and Indonesia, minimum wages are lower than in China, but labor productivity is also lower, making it difficult to achieve advanced manufacturing in the short term. Additionally, Vietnam has seen a significant rise in wages in recent years, gradually reducing its cost advantage. Political and geopolitical risks. Many Southeast Asian countries face political instability, requiring companies to carefully assess their expansion strategies. For example, in Myanmar, the military regime has led to the withdrawal of foreign investments, while Indonesia frequently changes its foreign investment regulations. Additionally, China's growing economic influence over Southeast Asian countries poses another risk factor for businesses operating in the region. Corporate responses and future outlook. Major corporations such as Toyota and Sony are developing distributed supply chains to mitigate risks. For instance, Toyota has established an EV production base in Indonesia, creating a manufacturing network that covers the entire Southeast Asian region. However, No single country can fully replace China's manufacturing capabilities. As a result, a multipolar strategy involving China, Southeast Asia, and India will likely be necessary. While supply chain restructuring is progressing, Southeast Asia still faces significant challenges in infrastructure, labor force, and political risks, making a complete transition unlikely in the short term. Companies must focus on risk diversification while maintaining flexibility to adapt to geopolitical uncertainties. Impact on investors and countermeasures. Stock market volatility and risk management. The prolonged US-China trade war exposes investors to increased market volatility. In particular, semiconductor, automotive, and high-tech companies are highly susceptible to tariff hikes and supply chain disruptions, making individual stock selection more challenging. For example, during past trade conflicts from 2018 to 2019 tariff war, major indices such as the S&P 500, Nasdaq, and Japan's Nikkei 225 experienced significant declines. Stocks of companies with deep ties to China such as Apple, Nvidia, and some fluctuated sharply with each tariff announcement. To minimize the impact of trade tensions, investors can adopt strategies such as defensive stocks and sector diversification. For instance, U.S. consumer staples companies like Procter & Gamble P&G and Coca-Cola, as well as Japan's domestic demand-driven industries such as telecommunications, railways, and real estate, tend to be less affected by economic cycles, helping stabilize investment portfolios. Emerging markets and investment opportunities in Southeast Asia. As US-China relations deteriorate, companies are accelerating efforts to reduce their dependence on China by shifting production to Southeast Asia and India. This presents new investment opportunities for investors. Vietnam strengthening its position as an electronics manufacturing hub. Apple and Samsung expanding investments. India growth in IT and manufacturing sectors. Apple and Foxconn increasing iPhone production. Indonesia and Thailand development of EV and battery industries. Investing in ETFs related to these countries such as VNM Vietnam ETF and EPI India ETF could provide long-term growth opportunities. Utilizing bonds, commodities, and hedging strategies. Amid ongoing market instability, investors should enhance their allocation to safe haven assets such as bonds, U.S. Treasuries, Japanese government bonds and gold ETFs to hedge risks. Additionally, with the potential for a stronger U.S. dollar, incorporating USD-denominated assets into portfolios can be an effective strategy. By combining sector diversification, investments in emerging markets, and the use of safe assets, investors can navigate the prolonged US-China trade war. Keeping a close watch on the latest economic data and policy developments while maintaining a flexible investment approach is crucial. Conclusion: the prolonged US-China trade war is expected to have a significant impact on the global economy, particularly on the stock markets of Japan and the United States. Both businesses and investors must adopt flexible and strategic approaches to navigate supply chain restructuring and market volatility. By continuously gathering the latest information and implementing thorough risk management, they can successfully navigate this era of uncertainty.